So the closing disclosure, you should be on page 182. 182, you're gonna see a sample of the closing disclosure. The first page of the closing disclosure looks an awful lot like your loan estimate, doesn't it? Make sure that you know that at the top right, you don't see the rate lock. So the rate lock is not on the top right. However, the type of loan and the information about the loan is. Your borrower's name, the seller's name, and the lender is in the middle at the top. And on the far left, you're gonna have the date it was issued, the closing date, the disbursement date, the settlement date, and the sales price. You're also gonna have, it looks just like I said, the loan estimate. You're gonna have the loan amount, the interest rate, which should be really close to the rate it was before, the monthly principal and interest payment, if there's a prepayment penalty or not, and if there's a balloon payment. Remember that prepayment penalties and balloon payments are usually on subprime or hard money loans, not Fannie Mae or Freddie Mac ones. Projected payments, you're also gonna have what you think the payments are gonna be, the principal and interest, if there's mortgage insurance, and the estimated amount for your impound account. Remember that the impound account is the same thing as the escrow account. They're interchangeable. California, we usually call them an impound. Sometimes they call them escrow, but they get confusing. Okay. The estimated taxes and insurance, so that's showing you how much they're collecting for your impounds or escrow account. And then it has the cost to close. You'll see that the closing costs are slightly different than on your loan estimate. Also, the final cash to close. Now going on to the difference. So that page looked a lot like your loan estimate, but now your closing disclosure is gonna go into the second page where it has who's paying for what. A line for the borrower, a line for the seller, and paid by others. But then you're gonna have the similar cost. You're gonna have section A, origination charges. You might wanna write in there, those are the fees that cannot change by anything. The next section, services the borrower did not shop for. If they did not shop for them, guess what? They cannot change. Services the borrower did shop for. These are fees that can change. Then you're gonna have the total cost added up, and then they're gonna have the other costs, recording fees. Remember that recording fees are in the 10%, and transfer taxes cannot change. Then they're gonna show the prepaids based on your closing date. So escrow will calculate how many days and what your prepaids are. So that's page 2 of your closing disclosure. Okay, the prepaids are where your clients are gonna be able to look at the prepaids, apples for apples, and see what the changes are. The cool part is to help a borrower understand on page 3 of the closing disclosure at the top is where your answer is. What changed and by how much and was it allowed to? So at the top you'll see closing costs, and you'll see where it says the loan estimate, and then it says final, which would be this closing disclosure. And then it does say, did it change? If it says, yes, it changed, is it allowed to change? Okay, so that's where you're gonna see yes and no, and you're gonna see if you have to pay them back any fees that you overcharged them on. Then you're gonna have a summary of the transaction, and that's gonna be all the numbers that add up to what you need to on the first page. And then on page 4 of 5 on the closing disclosure, is the loan assumable? Most loans are not assumable, so it's gonna say will not be assumable. If there's any demand features on the loan, most loans do not have demand features. Late payments, again, you should know that a late payment is based on the loan payment amount, usually 5% of the payment amount if paid after the 15th of the month. Negative amortization, most loans do not have negative amortization, so you'll mark the box that says no. Obviously, if it was a reverse mortgage, it would have possible negative amortization, but you wouldn't have the same disclosure. Partial payment policy. This is new to today's class, partial payment policy. So the partial payment policy, let me explain it very clearly. Let's say your borrower has a house payment of $2,800 a month. They go to pay their house payment and they're like, oh no, I only have $2,500. What am I gonna do? I gotta pay my payment, but I don't want a late fee. So they go ahead and they send in $2,500 instead of $2,800. The lender's gonna have one of 3 things that they're gonna do. Number 1, they're gonna accept the payment. I wanna bet not, okay? Number 2, they're gonna hold on to your money. They're gonna put it in a separate account, which I think is the smartest way to go because at least they have some of the money. And then when they get the rest of your money, they're going to apply it to your loan. However, you're like, oh, I sent most of it in. Do I get a late charge? Yes, you do, because you didn't send it all in at one time. So they're going to put it aside. When you send in the rest of the money, they'll go ahead and apply it to your loan. And the last option on the partial payment policy is they don't accept it at all. And they're just going to send it back to you. And that's pretty much what a lot of the lenders do. Now, in your education and for purposes of becoming a loan officer, it says you're supposed to know the partial payment policy of all the lenders you work with. The problem is you never know who the transfer will go to. So don't expect to know the partial payment policy of all the lenders, but it does say that you should know it. Underneath the partial payment policy is the security interest. They're disclosing to your client that their home is the security for this loan. If you don't make the payment, we're going to come and take your home away, okay? Next, on page 4 of 5 at the top, it discloses the escrow account, how much they're going to take out and why and how, and any information about the escrow account will be on the right side of page 4 of 5. And on the last page, page 5 of the closing disclosure, this is wake up call, okay? Wake up call says, you got this loan for $162,000. If you keep the loan for the full amount of time, you're going to pay what is that number? $285,000 on a $162,000 loan. It's almost twice as much over 30 years. They show you the finance charge, so that's the $118,000. They show you the amount you borrowed. They show you the APR. Remember, that number should be within 1/8. Remember that 1/8 on a regular loan? If it's an irregular loan, which we'll talk about later, an irregular loan has different payments. It can be a quarter different on the APR. Then it shows you that big number, the total interest percentage, which is the tip. On the closing disclosure, also it discloses to the client that within 3 days prior to consummation, they get a copy of their appraisal. And it has other contract details and liability if you go into foreclosure. The thing that I think was really great that they added to the closing disclosure at the bottom is all the people involved, their license number, their address, their name, and how you can get a hold of them. Because when your clients look to refinance again, they'll probably go, oh, I remember it was on that closing disclosure, and they can find you again. Then they sign and date it, and that's the closing disclosure.